Welcome everyone to this TradeStation webinar, a series where we highlight different option strategies, and today is all about Strangles. Before we get started and I pass the microphone over to Matt, let me just do some initial introductions and disclosures. As I said earlier, we are going to be talking about Strangles, and the title of today's presentation is Taking Advantage of Price Swings and Volatility. You can see that I'm joined by my friend Mat Cashman. He is from the OIC, and he's an educator and trader himself. So we're glad to have him here. And in a moment, we're going to share his expertise in just a moment. So before we get started, keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, especially when it comes to trading options, which carry a high degree of risk, and past historical performance is no guarantee of future results. If anybody needs additional information on these disclosures, please visit www.tradestation.com/important-information. And one thing that I wanted to mention before I let Matt take over the floor is I wanted to talk to you a little bit about the Options Education Center available within the TradeStation website. If you go to tradestation.com, hover over Learn, you'll see an Options Education section where we are highlighting options strategies. You can come to this carousel and go to the different articles that we have written. These articles also have custom workspaces that you can download and some PDF or instructional PDFs that you can also download. Matt has also joined us for different webinars. So if you scroll down on this page, you're going to find several of his presentations that we've recorded and made available here in the Options Education Center. In a moment, I'll link to the Options Education Center right here in the chat. So use the chat as a way to communicate with us. If you have any questions about the content, or if you'd like to learn a little bit more, please let me know. And I'll be standing by right there in the chat. But Matt, I'm going to pass the microphone over to you. I appreciate you being here with us. How are you doing today, Matt?
I am doing great today, Jesus. Thank you for setting the stage for us on the Strangles on the Strangles tip. It's going to be a good day. I'm always happy to be here to help present educational information about options. It's one of my favorite parts of my job.
Yes, I like that too. So thank you for being here with us. I'm just going to mute my microphone and turn off my camera. Matt, this is all yours, so you can start sharing your screen.
All right, great. We are, hopefully. Hello, everyone. Thank you for joining us today again for another TradeStation and OIC webinar. This one's on option strangles. As you can see, the goal of this presentation today, as many of them are, is to give you a solid understanding of these slightly more complex spreads, these option spreads, build on some of the knowledge that we've talked about before, and give you information about the nuanced risks and the opportunities that are inherent within these slightly more complex spreads so that you can utilize this knowledge and make better informed trading decisions. The more you understand spreads and their risk dynamics and the options in general, the better you're going to be equipped to translate that information into a game plan where you're going to be able to actually utilize these options as the flexible investment tools that they are. So they also, one of the things that I always talk about when I talk about options is that they also involve leverage, and it's important that you understand that and understand the basics of the leverage that they include, so that you can incorporate that into your understanding of the contracts and better utilize them in your investing when they're going to line up with your investment goals. So my name is Mat Cashman. I'm the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Really quick background on myself. I started trading in about 1998. I've been an options trader ever since then. I got my start in Chicago trading equity and index options on the floor of the CBOE. Pretty quickly after that, I moved to London and traded interest rate options there on the Boon Bobble Shots, which are the German 2s, 5s, and 10s, and stayed there for about 5 years. And then I moved back stateside, where I started and ran an index options market making business. again, on the floor of the CBOE. Currently, I work at the OCC helping individuals and investors to better understand both the risks and the benefits of exchange-traded options through efforts like the webinar that you're watching today on TradeStation. We always include a disclaimer ourselves. Everyone's got disclaimers because everyone has lawyers, and we like to keep our lawyers happy. So look at all the happy OCC lawyers over there. Any strategies that I talk about today, including actual securities or price data, are strictly for illustrative and educational purposes. Please do not construe them as an endorsement, recommendation, or solicitation to buy or sell securities, etc., etc. So, one other bit of housekeeping: the following trademarks, logos, and service marks displayed are owned wholly by the Options Clearing Corporation. You will see them used throughout the presentation today. Very quickly about the OIC. This is the organization that I work for that's inside the OCC. The OIC is the educational arm of our parent company, the Options Clearing Corporation. The OCC, or the Options Clearing Corporation, happens to be the largest clearing corporation of equity and index exchange traded options in the world. OIC, the Options Industry Council, started out as a collective in 1992 to better educate the public as to the risks and the benefits of exchange traded options. Currently, we continue to pursue that goal through the utilization of our website, which you'll see right here, optionseducation.org. There you're going to find online courses, podcasts, videos, webinars, an entire suite of educational material, all options centric, that we post on our website, and we're constantly updating and changing to try to meet people where they are, meet the investor where they are, with good, unbiased options information to help you build your knowledge base and just make better trading decisions. So, the one beautiful part about this is that when you go to optionseducation.org and you create a username and a password, you get access to all of this on demand and free of charge, because we are fully funded. We are a non-for-profit educational resource inside the OCC. We're fully funded by the OCC. The other thing you can do that I always recommend is options at the OCC.com. Right here is an email address that is staffed by 3 other members other than me, as well as me, of the investor education team at OCC. All 4 of us have over 25 years of experience each. So combined total, you're getting 100 years of industry experience on that desk. The one thing that we cannot do is answer really specific questions about like your options position. I can't tell you when to exit your Tesla call spread, but I can teach you how call spreads work most generally, and then give you a whole slew of information about what you should be looking for, or what you can be looking for, as far as the risks and the benefits of call spread positions and how those things work and things to keep on your radar screen, et cetera, et cetera. So that's one of the things that we do at OIC, is answer these email questions that come in. Remember, we're not registered investment advisors, so I can't direct you on trades or suggest investment strategies. But what I can do is educate you as to how they work. And then hopefully you can use that knowledge and make better trading decisions. That's the whole point of what we do. So with that said, let's talk about volume. Options volume for the last 23 years is what you're looking at here. This is a slide that I start every single presentation I do with, because it gives you an idea of what we're looking at now as far as the breadth of this options market relative to what it looked like, for instance, 20 years ago. I always point to 2008 when I bring this up, because I was standing in the SPX pit on the floor of the CBOE in 2008. And at the end of the year, I looked up at the full volume number of cleared contracts, and it was 3.7 billion contracts cleared for the entire year. Keep in mind, that was the most volatile thing that anyone had seen up until that point in recent memories, especially. But I didn't think that I would ever see anything like that from a volume perspective. And if you think about what has happened to the options market since then, last year we did north of 11.2 billion contracts of cleared volume at OCC. You can see that here. And obviously what has happened since COVID, since 2020, is that you're seeing almost basically a doubling of option volume over the last 5 years. What that means from my perspective, from my seat as an options educator, is that what we do on a daily basis in helping broaden people's understanding of these leveraged contracts becomes more and more and more vital every day to a healthy, functioning options ecosystem. That's part of the reason I put this up here. That's part of the reason I try to draw attention and highlight how much volume has changed over the last 10 years and kind of connect the dots as far as what that means for an educator in this space, because it's really important what we do as far as education is concerned. Let's dive right in. We're going to talk about strangles today. They're pretty simple option strategies. We're going to talk about what they are. We're also going to talk about how you might think about using them, how some people use them. I'm going to give you a couple of stories about how I used them way back in the day and how I used to think about them, how market makers sometimes think about option strangles, because they're an interesting thing to look at, especially when you think about them relative to duration on the actual duration curve. Strangles in the front of the duration curve are significantly different than strangles in the back of the options duration curve. I'll tell you why, and I'll give you some examples to show you how they're different and how they might move when you move things like implied volatility around. I'm going to give you the general P&L graphs. Strangle P&L graphs are almost like they're one of the simplest P&L graphs out there. And I'll show you what they look like from the long side and from the short side in a general way. And then we can talk about where each part of that graph changes depending on how much premium or what strikes are in the strangle. We'll get to that when we look at those. We'll talk about gamma and strangles. We're going to talk about implied volatility and strangles. This is a function of that that I just mentioned before, which is that they're different at different duration points on the options curve. Both of those things are important to think about when you think about this, the gamma and the vega of these strangles. Talk about the vega of strangles and what that means, and then hopefully we'll have some time for some Q&A. This is a little bit shorter than my normal presentation, so hopefully we'll actually have some more time for Q&A at the end. So let's dive right in. What are option strangles? If you've heard the term, but you don't know what they actually mean, option strangles are strategies that have been around for a long time. They've been around since actually puts and calls have existed at the same time. And they are a strategy that involves both buying a call option that is theoretically out of the money and a put option that is out of the money. So you're buying both sides of the price distribution. Generally, both of these options are in the same month, but they don't necessarily have to be. You could theoretically structure a strangle trade that is in 1 month on the call side and a different month on the put side. Sometimes people do that. Those are slightly more complex strangle trades, and they involve duration risk. Whereas if you put both of the options in the same month, you don't have any duration risk. You've got two options that expire at theoretically the exact same time. But these options have different strikes, obviously. They are out of the money calls and out of the money puts, usually. I'll give you one example where they're not out of the money options. Typically, strangles include out of the money calls and out of the money puts, like I said, and this is where the term strangle comes from, because when you think about where the P&L graph looks like, which is what you're looking at right here, the strikes form a strangle on either side of the actual asset price. So if you're dealing with a $25 stock, you might buy the 15 put and the 40 call. That would be we would call that the 1540 strangle, and you can quote it as one price as far as a complex, quote unquote, a complex strategy. But you're either buying or selling both of those options, the out of the money call and the out of the money put, and that's where the term strangle comes from. Quick aside, when we were in the pit, we used to use what's called ARB to talk to each other across the pit with our hands. You'll notice that as an old pit trader, I tend to talk with my hands a lot. The reason why is because for almost 2 decades, I spent the better part of 8 hours a day talking to people with my hands. And so I still kind of do that. It's a little bit of a vestigial part of my previous career as a pit trader. But when we would quote strangles or we would talk to each other about strangles, the ARB signal for strangles is, guess what? This. You would say, if you wanted to quote the 1540 strangle, you'd say the 15 40 strangle is $3 at $4, right? That's the market on that. And that would be a way that I could tell someone across the pit that the market on that strangle is 3-4. But this is the signal that you would use that you were quoting a strangle. Anyway, that's an aside. That's something that we don't actually use anymore because everything is theoretically electronically traded strangle. But you can trot that little fact out at the next dinner party that you go to. Let's talk about possible use cases for strangles, because this is really where the rubber meets the proverbial road as far as these strategies are concerned. Many times people use these when you're looking to profit from a large underlying move in either direction. Why do we say in either direction? The reason why is because they involve both an out of the money call, which gives you access and or exposure to the upside move, and an out of the money put, which gives you access or exposure to the downside move. And if you're buying both of those, you have exposure to both sides of the price distribution. However, you actually have to add both of those prices together to get the price of the strangle. That comes out in the actual break evens that we'll talk about when we talk about the graphs. But many times people use these strategies when they think something's going to move a lot, but they don't know which direction. And so you'll see prices of strangles historically get more and more and more and more expensive when potential events are on the horizon that are large movement centric events, but people don't know necessarily which side it's going to come out on, positive or negative. You'll also see when those things happen, strangles and straddles get more expensive, generally speaking. One can get more expensive without the other one getting more expensive. That's what we would call the wings going up relative to the meat. The meat of the options is the at the money options. We refer to in the market making community, we refer to those as meaty options, those 50 delta options. And then we refer to the wings as like 25 delta options and lower on the outside. One thing that you need to think about when you think about strangles is implied vol and how that affects the price of the strangle. We'll talk about that a little bit later as we're talking about it. One other use case that people use these for is as a hedge for other option positions. Strangles can be used to hedge weighted Vega positions, both long and short. So in situations, I told you I would give you a couple of stories about how I have used these in my previous incarnation as a pit trader. Sometimes when you're making markets and trading, you get put into positions that you don't necessarily want. The reason why is because your job is to just create liquidity, provide liquidity to the marketplace. And if someone asks you for a market, you theoretically have to respond to that market and give them a market and say, I'm 3 bid at 4. And if they say I'll pay 4, you have to sell them some. Occasionally you make markets that get lifted and you end up selling 500 of something at 4 that you didn't necessarily want to sell. In those cases, occasionally when we would be put into trades that we didn't necessarily want that had a significant amount of Vega risk to them. Let's say someone quoted something in the back of the curve that has a lot of Vega in it, and I sold it, or one of my traders sold it in the pit and we didn't want to sell it. And that puts us into a situation in which we might need to cover that trade. One quick way to cover trades like that is to just go quote strangles, because what they do is they give you exposure to both the call side and the put side. And the farther out in time you go, the more Vega they have, generally speaking, because both of those options, if they're out of the money options, are comprised completely of extrinsic value. And if you're dealing with extrinsic value, what you're dealing with is a part of the options curve that is really a function of implied volatility levels. That's why as you go farther out, they have more Vega. And as they have more Vega, as you go further out, they have more sensitivity to implied vol moves. And so if you move vol by 1%, a strangle that's in the front of the curve might move 30 cents, whereas a strangle that's in the back of the curve might move $3. So the reason I say that is that one of these use cases is for people to cover other option positions. Great way for us previously to cover large Vega positions was just to go as far back as we could that we thought we could get a liquid market, quote a strangle, and buy it. And what that does is it kind of beefs you up on both sides of your risk curve. It covers the calls and the puts, and you don't have to worry as much about your Vega exposure. One thing that's great about that is that strangles can also be used back there as speculative Vega tools. So if you have a really speculative idea about vol, about implied vol in general, the nice thing about strangles is that they're far enough away from the at the money that they're less sensitive to actual underlying movement. But because of what I said about them being completely comprised of extrinsic value, they're all Vega. When you get especially to the back of the curve, they're very Vega rich trades. And so if you have a speculative idea about implied vol levels in general, strangles are a great way to express that idea. If you think that implied vol is just too high, if it's 50 in the back of the curve and you think it should be 20, but you're a little bit worried about movement of the underlying, the nice part about strangles in that regard is that the actual difference in the strikes that you're using gives you a little bit more room as far as movement is concerned, and it expresses a very Vega rich expression of an idea as far as whether you think vol is expensive or cheap, because you're buying both the call and the put side. So that's a nice thing that people use them for as well. One other thing that strangles are really interesting about is that when you're dealing with strangles, you're dealing, like I said, with calls and puts, but you're buying or selling both of those options. And when that is the case, strangles and the use of strangles removes skew exposure. Skew exposure is actually the exposure that you have if you're buying the put side and selling the call side, or buying the call side and selling the put side. And what that means is that the actual implied volatility curve sometimes looks like this, with the puts over here and the calls over here. And sometimes if it tilts back and forth, you get a huge skew move, which means the puts in this case might come down where the calls go up, or the calls come down and the puts go up. But the at the money, as you'll see, this part doesn't move very much in implied vol terms. That's skew. That's the movement of skew. But guess what? If you're buying both of those options, you can tilt it both directions, and generally speaking, one of those will make up for the other one no matter what. So it doesn't always work perfectly that way, but using strangles sometimes in the back of the curve it can get you that Vega exposure that you're looking for without incurring skew exposure that you might get if you were trading something like a risk reversal in the back, where you're buying the out of the money put and selling the out of the money call. So those are some of the possible use cases. I hope I explained some of those adequately for people. Let's talk about what these P&L graphs really look like. Like I said, they're pretty simple. Because strangles are just two options, what you're dealing with is a put strike, a call strike, and how much premium you paid for it and or sold it for. So if you think about it in that way, your strangle graphs are always going to look like this in some way, shape, or form from the long side. This is the generic long strangle P&L graph. In this case, your put strike would be here. Let's say this is a $50 stock, with 50 being right here. You might buy the 25-75 strangle. That means you're buying the 25 put and the 75 call. Let's say you paid $5 for it. And let's say you paid $3 for the put and $2 for the call. So the combined total of those two premiums is $5. What's your break even on this trade? Your break even from the long side is always going to be the put strike minus the total amount of premium that you paid for it, and the call strike plus the total amount of premium that you paid for the structure for the strangle. So in this case, if it were the 25-75 strangle and you paid $5 for it, your break even would be 20 to the downside and 80 to the upside. In that case, the way that you can conceive of this is one of these options at expiration has to be worth the total amount that I paid for both of them for this thing to be profitable at expiration. And so if you paid $5 for it, either your call or your put need to be worth $5 or more for the strangle to be profitable at expiration. And this loss amount down here is defined by how much you paid for it. You can't lose more than what you paid for it when you're buying a strangle. It's impossible for you to lose more than what you paid for it because you have a defined outcome here. You are long the call. If it goes up, you theoretically exercise your call and you get long the underlying stock, or you're long the put. If it goes down, theoretically, you exercise your put and you get short the underlying stock to the downside. So this is what your long strangle P&L graph looks like at expiration. Conversely, the generic short P&L graph is going to look exactly the same, but the opposite way. In this case, let's say you're dealing with the same thing. It's the 25.75 strangle, but you're deciding you want to sell it. Let's say you have a very one-sided idea about implied vol, and you decide you want to sell the strangle, the 25.75 strangle. And again, you sell it for $5 total, $3 on the put and $2 on the call. In this case, your break evens are going to be exactly the same, except instead of wanting the actual stock to move outside of the range, you want the stock or the underlying to stay within the range. In order for you to break even on this trade from the short side, you need the stock to stay within this range here, which is where your profit is, but your break evens are exactly the same. They're going to be 20 to the downside and 80 to the upside. $5, the put strike minus $5, and the call strike plus $5. What you want is this to stay within the boundaries of the break even. And in that case, you would get to keep all of the premium for which you sold that strangle. This is basically how short strangles look, and the other is how long strangles look. There are always going to be some variant of this, with the largest differences being the strikes and how much space is in between them, how much distance there is between the strikes. That's what's going to give you the actual plateau or the bottom version of the strangle on the long side. And then the difference would be the actual distance from the put strike for the break even, and the distance from the call strike to the break even is going to be the premium of the total strangle. It's always going to be that way. The only difference is going to be whether you bought the strangle or whether you sold the strangle. And the amount of premium that's in that strangle is going to be a function of a couple of different things. Most of the time, it's going to be a function of duration, how many days to expiration there are in this option, and strike and implied volatility levels. So we're going to talk about all of those things. First, let's dig into gamma and strangles. That's what we're going to dig into first, because I think it's important that we talk about how gamma affects optionality and duration. Gamma of options across the strikes is important here. In this case, we're talking about a $25 stock. Down here, you have what we would call the out of the money puts, and up here, you would have what we would call the out of the money calls. These are the 20 puts, the 21 puts, the 22 puts, etc. And these are the 27s, 8s, and 9s, and up to the 30s on the call side. These are the out of the money options, and this is your at the money option. Over here is how much gamma is in each one of these options by strike. Now, the 20 puts and the 20 calls have the same amount of gamma in them. That's why this is expressed as one line. The actual gamma amount of the option is based on its strike, not based on whether or not it's a call or a put. The calls and the puts on the same strike have the same amount of gamma, because generally they have the same implied volatility and the same duration and the same, they have many of the same characteristics, and thus their Greeks are exactly the same on the same strike. In this case, you're talking about the 25 calls and puts as being at the money options. Most of the gamma is going to be centered around these at the money options. When we're talking about strangles, we're talking about these options that are over here. Maybe the 23 puts and the 27 calls. And if you look at those, they have significantly less gamma exposure than you do in the at the money options. That's going to be similar no matter what duration of option you're talking about. However, as you go further out in time, the disparity between the at the money gamma and the out of the money gamma amounts is going to flatten. These gamma curves start to get flatter as you go further out in time. The reason why is because as you go further out in time, and I'm going to talk about this a little bit, I'm actually going to talk about this a lot during this presentation, options get more Vega and less gamma. And as options get less gamma, they all start to get less gamma. And that means that the gamma curve starts to flatten. And so what you end up with is strangles in the back of the curve have more Vega and less gamma, but strangles in the front of the curve have very little Vega, but a lot of gamma, relatively speaking. Let's talk about gamma as a function of time. I just showed you gamma as a function of strike. So this tells you all of the gamma is basically in the at the money option. Regardless of where you are in the duration curve, the at the money option versus those out of the money options is going to have the most gamma. Let's talk about it in terms of duration, how far out on the curve you go. In this case, we're talking about the gamma of the at the money option. I want you to look at what this looks like. The 5-day option, the 10-day option, the 30-day option, the 90-day option. What this tells you is the at the money gamma amount for that option. As you look in time, what happens to the gamma? It's exactly what I just said. The further out you go, the less the gamma is of those options. When you look at it in just decimal form like this next to each other, it doesn't look that crazy. It doesn't look that stark. However, when you actually graph it, you can see it makes a huge difference. And this is just the difference between 5 days and 90 days. Look at the difference between 5 days and 10 days, right? It's a massive amount of gamma in those front month options, those options that are expiring right now within the next week, right? Those weekly options, those 0 DTE options, those things have a lot of gamma. And that is the case, regardless of whether it's the at the money or the options relative to the options in the back of the curve. If you trade an at the money option in that 0 DTE space, that's going to be the actual most gamma on the board because the at the money options have the most gamma, but strangles up front are going to have more gamma than the strangles in the back. All right, that is how gamma looks as a function of time. Let's look at strangle examples in the short-term options. So I'm going to give you a 5-day strangle. This option strangle is expiring in 5 days. It's the 25. Every strangle that I'm going to use is the 25 delta strangle. That's the 25 delta call and the 25 delta put. The underlying is $100 and the implied vol is 50 in this case. So we look at the 25 delta option on the call side and we come up with the 105 calls. This gives you what their profile looks like. It's a 25 delta. It has less than 5 gamma, 16 cents, 17 cents of theta, and only 4 cents of Vega. It's an 87-cent option. We add to that the downside strike, the 96 put. You'll see this is a 25 delta option as well. It is a negative option. It's a negative delta because it's a put. But like I said before, the gamma of these options is very similar. The 105 call and the 96 put are going to have very similar gamma amounts because they're kind of right at the same point. They're equidistant from the actual at the money. And that gamma curve that I showed you as far as gamma per strike, it's going to go straight through both of those, and they're going to end up kind of like right there on both sides. They both have the same amount of theta, and they both relatively have the same amount of Vega. However, the 96 put is worth a little bit more, 98 cents, because the actual skew that I was talking about, the put side is a little higher most of the time when we're dealing with equity or index options. And so you're going to pay a little bit more in premium for that option. When you put these two options together, you get what I would call the 105-96 strangle. or the 96-105 strangle. If I were quoting it, I would quote it either way. 105.96 strangle. It has a zero delta. Why? Because the call and the put deltas offset. One's long, one's short. But the rest of them are cumulative. The gamma is cumulative. You've got two options, the call and the put. The theta is cumulative. Vega is cumulative. And most importantly, the price is cumulative with both of those. So you're dealing with a $1.85 strangle here. It has 80 Vega, 33 cents of theta, and basically 10 cents of gamma. But it has no delta because the call and the put cancel each other out. Let's look at the same basic strangle, same 25 delta strangle, but we're going to have 10 days in this one. The setup is the same, 100 delta underlying and a 50 vol. Notice the 25 delta option, when you move farther out, becomes a little bit farther away from the at the money strike. Why is that? It's exactly what the reason why I said at the beginning as to the fact that the actual gamma of those options starts to flatten. The distribution of prices as you go farther out starts to flatten as well. And that means that the delta of those options, the 25 delta option and the 25 delta option on the call and the put side, actually are slightly farther away from the at the money. Hence, the 107 call instead of the 105 call, and the, I believe, 95 put instead of the 96 put. You can see that they're a little bit farther away. When you add those two together, you get the 107.95 strangle. The 10-day strangle in price is $2.30. It has a little bit more Vega, a little bit less theta, and a significantly less gamma. But the delta is the same, right? 25 delta call, negative 25 delta put, those offset. You've got a zero delta strangle, basically. It has no theoretical directional exposure. That's the 5-day strangle and the 10-day strangle. Pay attention to the price here, 185 and 230. Obviously, as you go farther out in time, these strangles get a little bit more expensive because the more time they have in them, the more expensive both of those options are going to be. But we're going to talk a little bit about how you can think about strangles and implied vol, because this is an important part when you start to get farther back in duration. Implied vol and strangles. Because strangles use exclusively out of the money options, like I said before, they're extrinsic value options. They don't have any intrinsic value. They don't have any parity in them. They're extrinsic value options. They're especially sensitive to implied volatility movements. That means that they have more Vega. More duration includes more Vega, and thus they're more sensitive to implied vol. When I showed you the 5 and the 10-day strangles, those Vega amounts were almost nil. They were less than 10 cents of Vega. Those strangles are not going to move very much if you move implied vol up 2 points or 3 points or 5 points. They're just not going to move as much as strangles that are farther back in the curve that might have 50 cents of Vega or dollars worth of Vega if you go farther back. They're much more sensitive to implied vol moves as you go back as a function of their Vega. So assuming that you use the same strike or the same delta and you go farther out on the duration curve, the more Vega those are going to include. That means they're more sensitive to implied vol moves, but it also means that they have more Vega and less gamma. In that scenario that I told you about at the beginning, when people get into situations where they have positions that they don't necessarily want in the back of the curve. Let's say they're short a bunch of Vega and they don't know how they got it, or they inherited a position from someone else that they took on. One of the ways that people look for a risk mitigating trade is they'll do things like quote a strangle in the back of the curve to figure out where people are pricing the Vega, the just natural Vega in the back of the curve. The reason why I say it gives you a metric, it gives you an idea of how people think about risk back there, is because those options have far less to do with the perceived movement of the underlying explicitly than the straddle does back there. The straddle is the two at the money options. The out of the money options are far more about just like how people feel about Vega. It's how people feel about the implied vol level, because the actual strangle itself, when you get farther out in time, is this really Vega rich thing that doesn't have a lot of kurtosis in it, which is like the amplitude of the wings. It doesn't have a lot of like movement built into it. What it has is just Vega. It's just this big Vega bomb in the back of the curve. So people use them for those purposes because of these characteristics. Let's take a look at some of those characteristics. Vega as a function of time. Let's talk about this really quickly. This is the exact same thing I showed you with gamma, but it's with Vega on the same time horizon, 5 days, 10 days, 30 days, and 90 days. Again, these are at the money options, but the out of the money strangles are going to look very similar, and I'll show you that in a moment. The 5-day option has 4 cents. The 10-day option has 7 cents. The 30-day option has 12, and the 90-day option has 20. Vega is proportional to time. And when you look at it graphed, it makes a lot more sense. This is your 5-day Vega amount. This is your 10-day, your 30-day, and your 90-day. These are all the same option. These are all the at the money option. But as you add more time to them, they just have more Vega. They're going to be more sensitive to implied volatility moves. Now, strangle examples as far as the longer term strangles. This is something that you need to think about when you start to think about strangles in the back of the curve. You have to start thinking about vol. You have to start thinking about implied vol. This is why. This is a 30-day option, 30-day strangle. Again, it's the 25 delta strangle. The underlying's 100, the vol's 50. In this case, we're dealing with the 112 call and the 92 put. Remember, when I talk about adding duration, the actual strikes that you use for the strangles that are going to be 25 delta options are going to continue to spread out farther away from the at the money. That is a function of the flattening price distribution as you go farther out in time. The 112 call and the 92 put, you add them together and you get the 112.92 strangle. It has 0 delta. It has 4 gamma, which is not very much, 14 cents or 15 cents of theta. It's a little bit of theta. This is where it starts to kick up. 18 cents of Vega, and it's worth $4.38. Remember, these are additive, right? $2 on the call side, $2.36 on the put side. Let's move farther out in duration. The 90-day strangle. The 122s and the 88s, again, we're farther away from the at the money, but they have the same delta, 25 delta options. You're going to add those two together, and you're going to get a 0 delta strangle in the 90-day bucket that is $7.80. Think about what we're talking about relative to that 5-day strangle that we quoted earlier. That thing was $1.85. This is almost $8 of premium. And then I want you to think about how that's going to react when vol moves, when implied volatility moves, because this is a significantly different Vega profile than even this is, which is the 30-day. This is the 1-month strangle, basically. This is just a 3-month strangle. These strangles actually can get really, really, really big the farther out you go. And like I said, when you go farther out, all that this thing is Vega, because it's all extrinsic option premium that has more and more and more duration to it, and thus more Vega. Here's how gamma and Vega look relative to each other as far as time is concerned. This is basically the same thing that we just looked at overlaid on top of each other. This is your Vega curve in time. These are the 0-day options, 5 days, 10 days, 30 days, and 90 days. Remember, Vega is proportional to time or duration. As you go out, you get more Vega. And as you come in closer to expiration, you get much more gamma. So not only do these strangles out here have very, very little gamma, they have all the Vega in them. And they're not going to be very sensitive to actual underlying movement. So the topic that we dealt with here is strangles, how to think about them relative to, movement. Most of the time, if you're going to be thinking about movement, you're going to want to balance the idea of how much gamma something has versus how much time is in it, because these strangles in the back of the curve are not going to be quite as sensitive to movement because of the fact that they have less gamma. let's take some of those strangles that we looked at and move the vol levels around and look at what happens to them. This was that 10-day strangle that we talked about, the 107.95. It starts with a 50 implied vol. It has 10 cents of Vega, and it's worth $2.30. The 30-day strangle, same thing, same delta. It's a little bit farther out, but it has 18 cents of Vega, almost 19 cents of Vega, and it's worth $4.38. And then the 122.88 strangle, which is that 90-day strangle, we're starting to get into the Vega strangle part of the curve. It's worth $7.80, and it has 32 cents of Vega. Keep in mind, Vega, the amount of Vega is an options sensitivity to implied volatility moves. And it's expressed as a decimal because it's the amount of money that should move relative to a 1% move in implied vol, or 100 basis points. So if you're moving vol from a 50 up to a 51, the options should move based on their Vega. So if you move an implied vol from a 50 up to a 51 and something has 10 cents of Vega, it should move roughly 10 cents for every 100 basis points, for every 1% move in implied vol. What we're going to do here is we're going to move the implied vol up 10%. We're going to take vol from 50 up to 60, and we're going to look at what these actual strangles look like when you move them. The new price of the 10-day strangle is $3.36. The new strangle price on the 30-day strangle is $6.70, and the new strangle price on the 90-day strangle is $9.04. That 10-day strangle moved a buck. The 30-day strangle moved almost twice that much, 187, and the 90-day strangle moved more than 3 times that amount, which is $3.21. In this case, a $7.80 strangle moved $3.21 in price. The important part that I want you to take away from this is that when you're thinking about option strangles and how you might use them, that there's always a mix as far as the options are concerned in how much gamma they have and how much Vega they have. And that's going to be a function of their days to expiration. It's also sometimes going to be a function of the overall implied volatility level. As you raise implied volatility levels, gamma of all options starts to go down. I know that seems counterintuitive for many people. I try to explain this with a lot of different ways to explain it, but sometimes it doesn't exactly hit home. The reason why is because as you take vol and move it up to a theoretical infinite level, all options start to have the same delta. Everything starts to have a coin flip kind of probabilistic outcome. Everything starts to have a 50-50 chance of happening as each one of those price iterations starts to become equally as likely. In an infinitely volatile market, you have no idea where things are going to be. It could trade 5, it could trade 50, it could trade 30, it could trade 130, right? Like everything becomes equally as likely. And so the gamma of all those options starts to go down. But that's implied volatility and its level. As you take implied vol to infinity, gamma starts to decrease. So it's important that you build that in as well. But really what I want you to do when you're thinking about strangles, because they're relatively simple kind of P&L graphs, but you need to understand what the risk metrics look like as you add or take duration into them or out of them. So that's, I think, the important thing I wanted to drive. Make sure that you check out optionseducation.org for all of our educational resources there. You can also send us email questions at options@theocc.com, which you can see right here. Let me take a look, Jesus, at see if we have some questions here.
There's a couple, yes.
Yeah. Will this webinar help me trade against Matt?
Yeah, I found that funny too.
I like that. I like that you left that one in there, Jesus. Thank you. Well, let me just say, as a full disclaimer, additionally to my original disclaimer, because of my position at the Options Clearing Corporation, where we clear like every single exchange traded option in the United States, I am strictly forbidden from trading options on anything we clear. So you're not going to see me in there making markets on options in stocks or in index options in the United States. Let's see. Is there a way to download the slide deck for us slow learners? Yes, there should be. And if there's not, you can send me an email and I will send you a PDF of the slide deck, or you can look me up on LinkedIn. I always post my slide decks in PDF form on my LinkedIn page afterward, and those usually go up like 15 minutes after. So I think I have a post that's going to go out at 2:15 Chicago time that'll have this deck in it. You can check that out. Oh, and Jesus put a copy of my slides right there. That's awesome.
Yes, correct.
Matt, is there a sweet spot delta to look for when selecting strikes if playing for price movement? Ooh, that is a great question. The sweet spot of that is going to be pretty dependent on two things. One is how close to the at the money can you get and how much do you have to pay for it? That's really what you're talking about. If you're talking about looking for a way to profit from movement, the closer you get to the at the money strikes, the more sensitive that strangle is going to be to the movement that's going to happen in either direction, but it's also going to probably cost you more money. That's the flip side of that entire coin. There's nothing that's given away for free in the options market. It's an exceptionally well-priced kind of ecosystem. And everything, from my perspective now, almost everything is perfectly priced, like all the time. And so as you, the one thing you can kind of rely on is that as you get closer to the at the money options, those options are going to be more sensitive to movement. So you're going to get more bang for your buck out of the movement, but they're also going to cost you more. You're going to spend more bucks to get the same amount of bang. So that's the sweet spot. The reason I use the 25 delta as an aside, most of the time when we're dealing with strangles, market makers tend to look at two kinds of strangles. One is the kind of meaty strangle, which is what I gave you many different examples of during this, which is the 25 delta strangle. Lots of people kind of default to the 25 delta strangle. The reason why is because it has this kind of interesting combination of they're kind of meaty enough options that they have enough premium in them that they're going to move up and down when implied vols move, but they're also not quite as meaty as those at the money options. The converse to that is what we would call the winged strangle or the wing strangle options. Those are like 10 delta, 5 delta strangles. Those are what we call kind of risk strangles. Those are the strangles that people come in and quote when they have risk issues that they just need to cover from a clearinghouse perspective. Like sometimes clearinghouses will come in and say, hey, your risk number down 50% in the S&P and up 70% in the S&P is heinous and it's violating the amount of money that you have in your account. Do something about it. One way that you can address that is by quoting what we would call the winged strangle. You're going to quote things that have like 7 delta, the 7 delta call and 7 delta put. And, you might need to buy those as a winged strangle. But what that means from a modeling perspective is that you have two kind of quadrants as far as how these strangles move oftentimes. That meaty strangle, those 25 delta strangles, are going to move much more as a function of how the straddle moves, as the implied vol level for the entire month moves, and those way out of the money options, because they have significantly less premium in them. They might be dime options or 20-cent options. They're going to move more as a supply and demand function. And the reason why I say that is because when you're talking about an option that's worth a dime, if someone comes in and pays 15 cents for it, that's a huge jump in the premium that's in it. And it's going to be a massive jump in the actual amount of implied vol, the implied vol level of it. Because in order to take a 10-cent option up to 15 cents, you have to move the implied vol a lot. Think about how much you just moved that option relative to its total value, right? You moved it 50% of its total value. So think about what that has to happen as far as implied vol in order to get that. If the only thing you're moving is the implied vol, you have to crank that implied vol up in order to move that from 10 cents to 15 cents. So that's why the winged strangles sometimes get thought of or conceived of in a completely different mental framework than the actual meaty 25 delta inside, what we call inside strangles. Will implied vols change after elections? Excellent question. I'm no prognosticator, but I will tell you, if you look at implied vol moves and things like elections or non-farm payrolls or earnings events and or like, interest rate potential changes, things of that nature, generally speaking, implied vols move after elections. Yes, they do move after elections, but I'm not going to give you. Why don't you do this? Go back and look at the money vol of any of the major indexes 10 days before the last 10 elections, going back 40 years, and then look at it 10 days after the election. And then send me an email and tell me whether or not implied vols move after elections, because I'm guessing the answer is going to become very apparent to you very quickly. Will the presentation be shared? Yes. Would a strangle be ideal around earnings or dividends? Considering for Tesla, since it moves dramatically during those periods. This is a really good question, and I want to talk about this really quickly. I have a couple minutes. Strangles are interesting because of what I said multiple times during this presentation, which is that they are completely extrinsic value. They are out of the money options on both sides. What that means is that what you're getting, especially when you're talking about something that's out of the money and farther out on the duration curve, is that it's a big, relatively big option that's all extrinsic premium. When you're talking about something that's an event-driven strategy, oftentimes those options, because of the way that implied volatility moves most of the time into events, is that implied volatility generally gets pumped up into something that is an unknown, right? We don't know how the earnings are going to be. And so if you look at the way that flows work going into unknown events, is people generally tend to buy options going into events, and thus implied vols go up. As you look at implied vols going up, what that also means is that in order for these strategies to pay off, you need a much larger move in the underlying as the implied vols go higher, because implied vols going higher means price is going higher, which means like the amount that's coming out of that option in theta after the event, or in just the amount of implied vol that comes out of it after the event, and we have more known information generally that goes into those, comes out of them after the event. The question is, has the thing moved enough to make up for the amount of premium that's coming out? So it's a double-edged sword here, and I know you're looking for a black and white answer, and I don't have a black and white answer for you. What I do have for you is I want you to look, when you're looking and thinking about those strategies, at how much. Remember, those P&L graphs are pretty simple, right? They're just like, how much did I pay for it, and how much does it have to move in either direction at expiration for the thing to pay off? I want you to look at those and think really hard about, when's the last time this stock or index moved this much? Do some research and think about what the actual amount of premium that you're buying for that strangle implies as to what percentage move in the stock you need for that to actually be in the money. Because the only way that these strangles become profitable at expiration is for one of those options to be in the money by the amount that you paid for both of them together or more. And so that can be a big headwind for long strangles, especially when you're walking into an event that's going to happen, that's going to give people a lot more known information than unknown information. One thing that known information does relative to unknown information is, after whatever underlying moves happen, generally speaking, implied vols come down when we know more or are more certain about what's going to happen. Implied vols tend to be lower when that happens. So I think I answered most of the question. Ooh, no, there's a lot more questions here, but
yeah, it's a problem. We're limited with time, and you know, I know that yes, presentations trigger a lot of questions, and as we've pointed out, there's plenty of educational resources, not only at the Options Industry Council, but also in the Options Education Center, which I've linked to many times here in the chat. Unfortunately, we do have to end the presentation. I am going to launch a poll, so please take a minute or two to answer some questions about this presentation. Matt, I want to appreciate the time that you spent here with us. It's always great to you know, benefit from your expertise. So thank you for being here with us.
I appreciate it very much. I'm always happy to come back whenever you'll have me, Jesus.
Great. Well, thank you guys for joining us today. Have a wonderful afternoon, and we look forward to seeing you in one of our future events. Goodbye, everyone.